Good evening. This is the Elliott Wave update for the NASDAQ 100 for Sunday, June 12th, 2022. Before I dive into the analysis for today, a couple of notes to make that I have rolled out to the September contract. And in doing so, that is going to have an effect on the high that we put in for minor wave 2 and what that low at the bottom of minor wave 1 was. So you're going to notice that for the minor wave 1, it completed at 11,528 basis the September contract, whereas the high for minor wave 2 is 12,982 basis the September contract. Basis the June contract, those numbers were 12,945 and 11,491 on the bottom. So we have a little bit of a difference, more so on the downside than we do on the upside. No, actually, they're about the same. Take that back. In any case, also what I'm going to be presenting tonight is I am using the ABC intermediate degree ABC off of the all-time highs to be more reflective on what I believe now we are coming down within. And so just to kind of begin there, the reasons that I've gone out is because I continue to believe that this is minor wave 1, but if it was minor wave 1 of the intermediate third wave, we would be truly, by the time we rolled out all 5 waves of intermediate degree, we would be down towards the 6,700 level, which is where I believe this entire A wave will likely complete down in that area. So I had felt that there was just not enough room. Now, having said that, let's kind of go in and take a look at what took place, starting with Friday's activity. The CPI number that came out on Friday, as I had left it off on Thursday evening, would dictate direction for this foreseeable week, was my thought. And if the number came out anywhere near acceptable to the market, or just where the market could grab onto it and run with a bullish picture, then I felt that the market could run up, break above all of our resistance levels, and get itself at that time above 12,945. Now, that number came out at an increase, showing that inflation again is at the highest level since the last 40 years, et cetera, et cetera. And as I had left that on Thursday evening, was that should that number come out and create a situation where we'd have a continuation of this sell-off that we saw on Thursday afternoon, then the count would suggest that the minor wave 2 would be complete at that recent high. And again, basis the June contract that was 12,945, basis September, 12,982. And that is the case. The market declined. It basically put in a mini crash, so to speak, for the balance of Friday. It was an expiration, which, as I had been discussing, I believe just produced a greater flow out of the market, because as the sellers were hitting it, it brought in additional sell pressure as it slid through strike prices in all of the issues that are within the NASDAQ 100, particularly Apple, Amazon, Google, Metaverse, Intel, Microsoft, Netflix, NVIDIA, et cetera, and Tesla. Tesla, desperate to hold itself above 700. In fact, after hours, bid itself almost back up to 710. After closing at 696, they were like, no way. And because they were going to have all of these 700 level calls and puts exercised. Well, we see who won that war. With this additional gap lower this afternoon, we are again on a fast track to breaking below minor wave one's low, which was 11,528. So what does that spell for what's happening inside all of this? Well, the best that I can do, and I'm going to drop this down to the hourly so we can see it, is see this triangle pattern is still kind of, it was nasty. It was difficult. It was what I felt at the time had a very strong possibility of being the case, based on the fact that I was still labeling this as wave A, and it was a B wave triangle. Triangles within a B wave, not an uncommon thing. The fact that we broke down on Thursday afternoon began to put a lot of doubt on that, but I kept it alive on the fact that, okay, we've slid through, which an E wave can do very, very often. But I had my doubts because of the depth that it slid through that lower border, the lower support line, a little bit and then a turn. And it slid and we got no turn higher, except in the very last piece of the afternoon, we saw buyers move in for the expiration settlement. Now, what I'm looking at here is that it ended up being a 1-2-1-2. And then now we're beginning this subminute third wave. And that's what all this is. And we have all of the points of recognition. And basically right now, we've got 3 of them. And this is where, particularly this Friday's action, definitively point of recognition. When the markets and investors and traders and everyone involved realizes that because of that number, we are going to go down based on inflation still being out of control, that pushes the Fed into stronger action that they likely will have to take on Wednesday, which again brings about, is Powell going to eat his words? Don't see the necessity that we're going to have to push higher than just a half a point rise, or is it going to be 3/4, or is it going to be a full point? Now, those of us that may be up in the age bracket that I'm in, that were in the markets back in the late 70s into the early 80s, particularly 80, 81, the last time that inflation truly ran out of control and the Fed stalled and the Fed played around and the Fed did not want to start pumping up the interest rates because of what that does, number one, to the economy, and number two, just to the money that was needed to do what was going on at the time. So along comes Paul Volcker. He gets elevated to the chairman of the Federal Reserve, and he immediately went to work and started to raise those rates. I remember him talking and having press conferences and telling everybody that this is what was needed, and this is what was going to happen, and that it was going to create some pain. But it's best that we take the pain now rather than drag it out over several years and truly destroy our economy. So what did eventually happen is that the prime rate, the Fed funds, went up above 18%. And now that might seem totally unrealistic, but if you look at a yield chart for the 30-year bond, you will notice that, let me see if I can pull that up. Just have to remember what these codes were. Yeah, nope. I think it's going to be 30-year. Let me go all the way over. Futures yield. July. Yeah, that's not it. There are yield charts that you can look at that I can get the longer views on. And therefore, I can see that in 1981, that's where interest rates hit their high. And then recently, all the way in 2021, is where they hit their low. And so what we're really looking at is a 40-year period. That's how long it took to go from the high to the low, 40 years. So to believe that coming off of those lows, that 6 months is going to take care of everything, I believe is just an unrealistic view. It takes a lot longer for inflation to filter through our whole economic system, our whole, all of the economy. And as I have suggested to several of my coaching clients, that if we look at the pecking order, so to speak, the food chain, so to speak, at the top of that pecking order are interest rates. And the reason is because interest rates will dictate what happened, everything from there on down. It's interest rates are where what we can borrow money, what rate we have to pay to borrow money, and what rate we get when we lend that money. So considering that they were sub 1% for a while, and there was just way too much money printed out and lent out at basically 0%. That's an incredible feat. And for it to continue was a very unrealistic view. It is just virtually impossible for a country the size of the United States, with the commitments that we have on a global basis, can sustain itself by continuing to print money and offer it out at almost 0% interest. The line went around the block, so to speak, folks. So, but those days for right now are over. And now we're having to deal with the fallout from doing that, the fallout from having to basically bail out the corporate world in 2008, 2009. And then fast forward to 2020, to 2021, and to 2022, we needed to bail out the consumer world because of a pandemic that literally shut down the globe. For us, it shut down the United States. We could no longer go out. We could no longer run to the grocery store or run out for a concert or just do anything. We were confined to our homes. The good news is that most people were able to shift and work from home. But there were many that worked in the service industries that could not. And they lost their jobs. So we saw unemployment run up, et cetera, et cetera. The only thing we could do as a government was to pass trillions of dollars to be printed and to be given out to keep the economy afloat. And that was on a consumer level. A lot of corporations also participated in that. And then they were purchased and they were bailed out yet again so that they could keep their employees working and keep the economy going. Now, all of this takes a long time to filter down. And that's what we're going through now. The system is filtering it through. We're seeing it smack retail again and again and again. Our first big major hint that everybody just kind of tossed off, I feel, was Amazon last quarter after reporting billions of dollars in profit. And I mean billions, 21, 30 billion, on and on and on. Because of the pandemic, everything was brought in. We had to order online. It was shipped to us directly to our homes. Amazon made sizable amounts of money. Now, we get all this inflation going. And then what happens? Amazon turns around, and last quarter, reported quarter, they had a $6.8 billion loss. That was stunning. Most people just kind of wrote it off. Why? Because they announced a stock split at the same time. Interesting fact. Interesting. That does not by any means, but that supported the stock price. Because the belief was at the time, and still is, well, when a company that size announces a huge 20-for-1 split, wow, I'm a retail trader. I'm going to go in and buy 2 or 3 or up to 10 shares, and I'm going to end up with 20 times that amount when the stock splits. And we all know what happens when stocks split. They run back to new all-time highs. Under perfect conditions, yes. Under the current conditions, no. That's not likely. It may get there eventually, but we got a whole lot to do before we get there. So bringing us up, interest rates. Then we have the bond market. We have the dollar. We have bonds. Then we have equity. We have corporations and corporate bonds. And it just goes on and on and on. And it's thick, and it takes much longer for it to filter all the way through. How will all of these companies, what are they going to do? How is it going to affect their earnings? When you have someone that produces a product, but they have to buy the bits and pieces that create that product, those bits and pieces are going up in price. And it just goes down the chain. And that's where we're at right now. So when I'm talking about this repricing structure, this repricing season, or whatever we want to call it, we're still in it. We're definitively still in it. Now, pay attention to the news now, because now that we've got it staring us right in the face, watch the financial media. They're going to change their tune. Oh, consumers are at their lowest and they're gloomy and gloomy. Oh, housing prices, get ready, get set. They're going to just absolutely get devastated. Why? Well, because interest rates are going up. 2, because the cost of the building materials is going through the roof. And there's going to be no way to recoup that, because people still have to line up to buy these homes. That's another one. So now we got to filter it through that system. So you can now see how and why this takes longer to do. It doesn't just happen like bing, bang, okay, we're done, let's move on. No, there's a long process, and it filters all the way down. So just remember, it's filtering down the ladder, the structure, and we're not done. So we're going to continue to hear, I believe, coming up when we're ready for next quarter, right? When we're ready for second quarter earnings reports, on how it's really affecting them. And I don't think it's going to come out very well. So as we progress this year, back to the market and the wave count, we're coming down in a minor third wave. And best, so that I can count what I suspected was a triangle, ended up not being. And just before I continue, this is another reason why, when I'm making my updates during the week, and also inclusive today, I will give both sides of the coin as best I can. I discussed the triangle pattern. I discussed what the market would need to do coming out of that triangle pattern. This is all how I left it on Thursday. It didn't. And that took us over to the additional scenario that I pointed out, that if it continues to break down, which it did, then we're putting the minor wave 2 here, and we're starting off in a minor third wave decline, and it's going to push strong lower. It's a third wave. Under Elliott, third waves are often, most often, the longest and the strongest out of that impulse sequence of waves 1, 3, and 5. It's normally the longest and the strongest. The rule is that the third wave does not necessarily have to be the longest. It just cannot be the shortest wave out of 1, 3, and 5. But as the third wave, it's quite often, most often, the longest because there we are in the dead center. What sits also within that third wave is the points of recognition, where the market players, investors, traders, etc., realize we are going to go down. And we start to see a larger exodus. That's what we got Thursday afternoon. That's what we got all day on Friday based on that figure. As soon as the market can get that information, boom, then that's what we can put together. Now, within this third wave, there are going to be 5 waves of minute degree, of which 1 and 2, that's what ended up happening. Instead of it being an ABC, it was 1, 2, 1, 2. And then it breaks again, but this one I can just count it out without getting super detailed. So what I can pretty much put together is that within this sub-minute wave 3, and that's larger minute wave 3, is a 1, 2, and then we get a second one, and then we get down here. So if I had to do it from here, 1, 2, 3, 4, 5, maybe, that would put the minute 3 here, the sub-minute wave 3 here, the sub-minute wave 4 here, and now we're in sub-minute wave 5. And that's just to put in the minute wave 3. What we got after that is a minute wave 4 and a minute wave 5. But this is got more to go. So definitively, minor wave 3 will break the low of minor 1 on the way down. So what I've also included, and I'm going to go back out to that daily, what I've also included are now the Fibonacci levels for the minor wave 3. What does that include? We're comparing minor 3 to minor wave 1. That's what we have to work with right now. And it's not a pretty picture for anybody who's bullish. Minor wave 3 would be equal to the length of minor wave 1 at 9,204. So basically, kind of what I've been talking about here is that we're going to get into a position where we will be more crash-like. Now we're getting more information that that's the case. And here we are sitting once again on a daily level where the markets are beginning to look extremely oversold. So let's wait and see if we got somebody who really needs to have higher prices come out and make a statement, a JP Morgan, a Morgan Stanley, a Goldman Sachs, someone who's like getting paid the big bucks to put out statements like this, that markets are extremely oversold, buy it. They've done it. They did it here. They tried it here. They did it here, et cetera, et cetera, et cetera. They may come up and do that again. Let's take a peek at that weekly chart. Look what we just broke. They are struggling beyond words to hold this up. It's at 17,000. Oh, come on. It's everything's in the way. But as I think it was at 17,055-ish, maybe 35, somewhere in that area, and we are below it. And they're desperately trying to hang on to 11,700. Not sure why, but that's where they're at. And once we get a clean break below this on the weekly, so we got it actually all week, because on a weekly basis, the market would need to close below the 200 to put in weakness on a weekly basis. So we still have to all night and all day tomorrow and the balance of the week before the weekly chart would show us a weakness. And on this level, folks, it would be extreme. Now, remember when we were here, and that's when we made the last low, and then we launched because the weekly chart was so oversold, and it was extremely oversold. But now I'm going to say it again. Markets can crash from an extreme oversold position. It is not super uncommon. It has happened, and it can happen again. I'm not calling for that, so please don't believe anything on the fact that it's like, well, you said, because that's not what I'm saying. I said the potential and the possibility is there. Now, trying to build a bullish scenario out of all of this is not healthy. It's not going to be healthy for your P&L. We may and we will get bounces during this whole period. We have been getting bounces, and they have been strong. I would be looking for the VIX to truly be above 30 to 32 starting tomorrow, or when it comes back online. Let me see, is it trading? No. But these gaps, they're strong. Now, if this thing clears it and starts to really come down, that's going to bring in more sellers. The sellers will be present, and it will happen. And then what do we got? Here we are in the weekly. This is Fibonacci support for the progress of the minor third wave. Before I get into that, let me go back to say what I'm counting on the weekly, daily, hourly chart. Again, this high, 16,768, all-time high, remains in place. It has not even been challenged. So there's no threat to that level right now. So I'm going to continue to count it as the completion point for intermediate wave 5, primary wave 5, cycle wave 5, and super cycle wave 3. Okay, so what type of correction are we in? We're in a fourth wave correction on a super cycle level. So what does that tell us coming off on the cycle level? Well, we're due for an ABC decline. And what does that tell us on the primary degree level? We're due for an ABC decline. So if we all the way back down, here on the intermediate degree level, we're also going to do an ABC decline, but I always will start out counting it as numeric, that the A wave will be 5 waves down. On the intermediate degree, it was holding, it was working out pretty well, but then suddenly we got this. We got 7 weeks of a down market. That kind of really tossed for me, where are we? What are we doing? Yes, we're still in the decline. Yes, I can still call it an intermediate third wave, but it's still held. So when I put in my Fibonacci's now, it's still held that the Fibonacci's are going to bring it sub 10,000. And in actuality, a third wave would be the longest and the strongest. You're looking, it's going to come down here. Now we're in the area of the previous fourth wave. Well, that's where I'm expecting primary wave A to be put in. I'm still looking for primary wave A to come somewhere down into the area of the March 2020 lows. And then we're going to put in one hell of a B wave rally. So I think it's time to kind of wrap yourselves around to what the reality of the market is. And no, I'm not a perma bear. No, I'm just not always bearish. No, I'm neither. But I'm going to tell you what the market's likely going to do, which is bearish because it's going to go down. So just by nature of how we title everything, it's a bearish move. Prices are going to move lower, and we've just begun. That's the point I really want to go. We've just begun. So again, I just as a trading statement, we're at a time right now where you cannot be buried under a bullish or bearish scenario. The markets are going to pick up speed. At volatility in the futures market, it's going to equate to the speed, the velocity of which the moves are going to occur. Now, if I'm expecting the velocity to increase to the downside, it would be unrealistic to believe that when we get a bounce, that it would be super slow. They're not. They're going to react in the same thing. Why? Because they're computer generated. Orders come in via the computer. Orders really, I mean, yes, we can put in a limit order, but when you're looking to buy and sell futures on an algorithm, they're at the market. And so when they come in and boom, they're done, and then they go. So the velocity, the speed will be present on both sides. To be bullish or bearish is likely going to be a detriment. So again, if you're more that, well, I need to position myself because I'm more of a swing trader, you're going to need to build swing trades for the downside. You're going to need to kind of pick your points and realize, well, this is where I think the market can go. What type of position can I put down? An options position, a futures position. Again, and then you can be looking at these individual stocks. Very few of them, if any, are going to be able to skirt what's happening to the economy. So therefore, they all will participate. And if they're a component of the S&P, the Dow, the Russell, or the NASDAQ, they will most definitively participate. So there are lots of positions that can be had. And you can have defined risk. So it's not like you're going to be hanging out there, just waiting. You can put on defined risk positions. You can become a day trader. And what a day trader, I don't carry positions overnight. Well, I'm more of a swing trader. You can still swing trade during the day. But again, many things you can do. And please, if you have an interest, if you're really looking for something, drop a comment. I like the questions. I answer the questions. I do offer coaching. I do have a few of the things where I like the participation of other people, and I discuss a lot more. Back to what I think for tomorrow. On the weekly chart, getting negative. Now, we haven't actually gotten to the Asian markets opening yet. We haven't actually, this is all coming on our own inflation numbers. So there's other things that are going on in our country, in the world, that are not being reflected into the structure of the pricing yet. So a lot more to come. So I'm thinking that we may see an additional strong down day. This is the beginning stages of this minor third wave. The minor third wave does project at least down to 92. That's where it becomes 100% of wave one, if not deeper, before we see a little bit larger, stronger, sustained rally phase. And again, it'll be an ABC. So while we are trending, which I believe is what we did on Thursday, which I believe what we did on Friday, trending markets are a little bit easier to trade. Let's take a look. Going back to that weekly chart, trending markets are easier. We did have one serious pop that week, but it was taken over and boom, we came back down. Now, we can pull it down to the daily. Downside moves, good. Let's pull it down to the hourly. Downside moves, I'm going to open this up a little bit. Look at that. Boom, boom, boom. Yes, there were little rallies in here, but they were actually just levels that you could, if you're a day trader and you're a scalper, great, you could scalp the long. And you're looking for additional shorting opportunities because you're looking for the next leg. This was the end of the day. It was really obvious because, actually it wasn't, I take that back. But this is towards the end of the day. But the overnight and then the first 2 hours, pretty strong. Then we had some decent rallies, and it was tradable. It was okay to trade. And here's another thing. It's like, as you're getting wrapped around what is actually happening, please remember, nothing goes straight down, nothing goes straight up. We go through ebbs and flow. Market goes up, market comes down, market goes up, market comes down, even within these smaller moves, because Elliott continues to function. Looking for an ABC, okay, A wave's probably going to be a 3, B wave's going to be a down 3, and then we've got a C wave up. C waves are always 5. Understanding Elliott helps you when you're trading these smaller moves. They're all going to take place all within the day that you're trading. Okay, now, that was actually, nope, I got to go up to that high. So if we're coming down, let's say we're just coming from here, 1, and this is the 2. Then we got a 1, 2, and then we got a 1, 2, 3, 4, 5 of that 3, and then we got a 4 and a 5, but we're still within that 5th. This is not done yet. So I am expecting this market to break below, or at least get itself down to 11,539. And then we're going to see what's going to happen, because we still got Asian markets to open and deal with it. Then we have European markets to come up and deal with it, plus their own stuff. I mean, we still have, China's got to deal with what's going on in China, Australia, New Zealand, got to deal with what's going on in New Zealand, and how what's happening in the outside world is affecting them. Japan, Hong Kong, all of these markets, they got to deal. So there's going to be those internal stuff, plus having a reaction to what's happening here. So I don't really see that we're going to get a whole lot. I expect bounces, yes. But if I had to keep breaking this down and just keep looking to see where we are and where can we look to be, if anything, 1, 2, 3, still, then we get a 4 and a 5. And is that going to be the 5? I don't know. 5 are, it could be 1 to 5. I don't know. I still think we're in a stronger down sequence. We're inside of that strong down sequence. We're inside of the strongest down sequence. So I'm expecting to see a lot more than what we've just already done. So tomorrow, stay on your toes, stay alert. If you're coming in and you need to adjust your position, here's partial what I can say to it that would address that. One thing I talk about new traders is having a set of trading rules, your trading rules, not mine. They're going to be different. Yours are going to be different than everybody else's. They have to be. It's your account. So you're basing it on your account size. You're basing it on your goal for each trade. You're basing it on what is going to be my trigger for an entry. How much am I willing to risk on the trade? Where does that level come in? What is my trigger? Then what is my target on the trade? When you're using moving averages, it makes it a little bit easier, right? Break the 4, looking for it to get up to the 8. Break the 8, I'm looking for it to get up to the 20. Of course, this is the hourly chart, but they work the same all the way down. So, but here is what something is most important, and many, many people lose their courage or lose their rules, is being willing to get out of the trade when the trade becomes invalidated. What does that mean? It means when it goes past a point that the trade is not going to happen. So in other words, it's going in the other direction. It is not going to turn and run all the way back to there. It's likely going to continue to go down. So you get out of your trade, hopefully at a small loss. When you're trading off a 1, a 2, and a 5-minute chart, or even a 50-minute chart, you can take a small loss, see what's going on. If you need be, you might take the next trade, and it'll be in the direction you just got out of. But at least you're not working it from a negative. You're back in, and your goal then is to make your money, but also it's much easier to recover off of a $200 or $300 hit than it is a 2,000 to 3,000 or 20,000 to 30,000. Those blowout accounts. We want to trade and live to trade another day. You must learn to have some good risk management, putting it in place. Tomorrow, again, I still think we start to come down. We continue to go down. Yes, there will be bounces. Yes, some of them, most of them should be tradable. Most of them should help to provide some decent levels. And I'm just taking this all the way down. See, we don't have anything yet. I'm going to go down to this 5-minute chart. We don't have anything yet. But you can see, here we are. We're playing around the 4, the 5-minute 4. Same concept. It breaks above this 4, we can get above, then we're going to the 8. Breaks above the 8, well, okay, we should head to the 20, et cetera, et cetera. Downside, I've just laid out. We have support at 11,539, 11,000, that's right above that low at 11,528. A break there, we should get some acceleration. Our next stop is 11,093. We don't have price support. Now, look how far left I'm going. I'm back into July of 21. Support is not available. What's my weekly chart tell us? The weekly chart is also showing us, oh my, look how far I got to go. I have to go to November of 2020. This is where we are. This is how it comes about. You want crash-like? Why? Well, because they took it up like that. It was a crash up. Now we're going to be crashing down. And we have much bigger gaps between support, much bigger gaps between Fibonacci support. Be aware. That's all I'm going to say. Be aware. Work out your own analysis. Work out your levels. If it starts to break down, you're going to see we got 11,093, 10,600. That's basically 350 points. Then we got 318. Then we got another 340 points. And then 10,012. There's another 300 points. So basically between these levels are 300 points. So when I'm talking about it could be crash-like, well, yeah, it can. It's going to go fast because we don't have the points to go, I can hang my head on that. Good, I'll step in and buy it. Okay, I am going to leave it there because this is now getting pretty lengthy, but I wanted to spend this time because these are important times. This is going to be a tough market and we need to go in and make the money. So continue to use moving averages all the way down on those 1, 2, and 5-minute charts, 50-minute chart. The same message when they break above or below. The same message is, it's just universal. Follow the Fibonacci. Look at the Elliott. Count your waves. And have a great trading day tomorrow. And again, please leave a comment. I'm not asking for someone to say I'm crazy or I'm nuts. But if you have questions, put your question out there. I always answer. And our next update will be on Monday, the 13th. Have a great trading day tomorrow.